Hello everyone and welcome again to Talent Sprint. We have seen in the last 5 videos what is capital and financial intermediation, and we have also seen in detail about the one type of financial intermediary, namely the mutual funds. That was spread over a 4-part video. I hope you enjoyed watching it. Now we will continue with the rest of the financial intermediaries, and taking up for discussion in this video is the insurance companies. Insurance companies have been playing a very, very vital part in the financial intermediation in our country ever since the formation of the Life Insurance Corporation of India in 1956. And for the last 61 years, insurance has been a major part of the financial intermediation in India. So we shall now go in this video and the next. I have divided the insurance into 2 videos for easier understanding and for easier assimilation of thoughts. So in these 2 videos, we will see what is insurance, what is life insurance, what is general insurance, what are the various types of life insurance policies available to a customer, what are the various types of general insurance policies available to a customer, and so on and so forth. And again, like mutual funds, insurance too is very much a part of the bankers, if I may call it, ammunition, because today almost every bank either has an insurance company of its own, like for example HDFC Bank has got HDFC Life Insurance, ICICI has got ICICI Prudential Life Insurance and their general insurance arm as well. HDFC also has got their general insurance arm called the HDFC Ergo, and similarly you have the State Bank of India, which has got the SBI Life Insurance Company and so on. So not only the banks have their own insurance companies, but also insurance is very much a part of their cross-selling activities to their customers. So it's natural that we understand more in detail about insurance, what are the various types of insurance, what is insurance first of all, and go on to see what are the various types of life and general insurance policies available to a customer. I'm sure you will enjoy watching these 2 videos, and let me go straight away into the topic by asking, what is insurance? Insurance is an arrangement by which a company or a state undertakes to provide a guarantee of compensation for a specified loss, damage, illness, or death in return for a payment of a specified premium. Don't be flabbergasted by the long winding definition of what is insurance. Insurance is simply compensation for a loss. Insurance is compensation for a loss. The loss could be either the loss of one's life, or the loss of one's earnings, or the loss of one's limbs, either due to partial or total disability, or it could be loss of one's manufacturing equipments. It could be the loss of a factory or a godown or anything. Insurance is nothing but loss in case of a compensation in case of a loss, and this compensation is provided by the insurance companies to the customers in return for what is known as a premium. This premium is paid by the customers at specified intervals of maybe half-yearly, quarterly, annual, and so on. And this premium is collected by the insurance companies in advance. Let us make it very clear that insurance premium is not paid post facto. It is a prepaid arrangement. So an insurance is an arrangement by which a company or the state could also arrange for insurance to its citizens, undertakes to provide a guarantee of compensation for a specified loss, damage, illness, or death in return for a payment of a specified premium. Insurance is just compensation for a loss. It's a means of protection from the financial loss. Insurance is protection. Let us first and foremost understand this point, that insurance means protection. Insurance is not investment. Although of late there have been a lot of hue and cry about the way the market is marketing the investment-linked insurance products, in my personal opinion, insurance is first and foremost protection. For investment, there are many other investment opportunities available, and insurance is first and primarily a loss being compensated. To that extent, it is protection. It's a protection from financial loss. A financial loss could arise due to either death or illness or disability, or a loss of equipment, factory, godown, vehicles, etc., etc. It's basically a protection from a financial loss caused by damage of any kind to any person or anything. It's a form of risk management. Basically, insurance is a form of risk management. You have to manage your risks well. In today's world, every activity of ours is surrounded by risks of various kind, and it is natural and it is necessary that we have a risk management system in place. For that purpose, insurance is a risk management. It is compensation from loss, for loss, it is protection against financial loss, and it is a form of risk management. And it is non-catastrophic. The characteristics of insurance is that it is non-catastrophic. What does non-catastrophic mean? Meaning that all the losses do not happen all at once. The chances of every citizen of this country dying on the same day is virtually nil. Similarly, the chances of every godown or every factory in this country catching fire is probably nil, unless there is a catastrophe, unforeseen circumstances which mankind has not seen thus far. So it is probably the doomsday which can cause such a big catastrophe that everything on the face of the earth is wiped out. Then insurance companies also will get wiped out. There is no meaning for insurance at that point in time. Insurance runs on the principle that not all events happen at once. Not all losses happen on the same day. Not all deaths happen on the same day. Not all illnesses happen on the same day. So to that extent, the characteristic of insurance is that it is non-catastrophic. Individual losses are not severe enough to bankrupt the insurer. The insurer collects premium from various people, and that is the premium collected is the amount with which he pays the claims of the various insured people. Now, the chances that the entire premium collected from the various clients would get wiped out by the loss to a single individual are next to nothing. Let's assume that a life insurance company has 100,000 clients. I mean, most life insurance companies have hundreds of thousands of clients with them. Just for a hypothetical example, I'm saying that let's assume that a company has got 100,000 people insured with it for life. What are the chances that if one of them dies, the entire financial system of that company will go haywire to render it bankrupt? It is impossible, because a single man might be insured for, let's say, even an amount of 10 crore rupees. 100,000 people having paid a premium would have paid much more than 10 crores of rupees to the individual, or to the insurance company. So the death of one individual will not render the insurance company bankrupt. That is the meaning of the word non-catastrophic. Not only do all the deaths or all the damages not occur on the same day and the same time, but the damage created by the loss to one individual will not make the insurance company go bankrupt. That is the meaning of the word non-catastrophic. That is the characteristic of insurance. Insurance works on the probability theory. What is the probability that so many deaths will happen at a particular time? What is the probability that so many fire accidents will take place? What is the probability that so many equipment will be damaged? What is the probability that so many aircrafts will crash within a given period of time? These are all the various kinds of probabilities which the insurance companies work with, and the probability of all these things happening on the same day, at the same time, in the same year are virtually next to nothing. And that is why insurance companies are going ahead and doing this insurance business. Otherwise, no company would ever take up insurance business at all. I'm sure all of you would agree with me. What has been the rate of air accidents in the last few years in the country? Probably in single digits. And what is the premium collected by the insurance companies from the airline companies? It runs into trillions of rupees. Of course, an aircraft costs probably 900 to 1,000 crore rupees, but then the premium collected is far, far higher than that. And what has been the rate of accidents in the last few years? It's probably in single digits. Thank God for that. Similarly, what are the chances of all the people dying on the same day? It is virtually next to nothing. So that is why it is called the probability theory. What is the probability that such an event would happen on the same day, at the same time, in the same year, at the same place? And insurance companies work on that probability theory to fix up the rate of premium so that they can settle claims without any difficulty and without they going bankrupt. Insurance is to protect the well-being or the financial well-being of an individual, company or other entity in case of an unexpected loss. This is a very important characteristic of insurance. Insurance is to protect the financial well-being of an individual, company or entity from unexpected losses. A couple of words here are very important. Number one, insurance is protection from financial loss, which means that supposing a person has taken life insurance and the insured person dies, the family of the insured person is not going to get his life back. His life is gone forever. But then, because the person has died, there could be a lot of financial loss to the family because of his sudden death. He might have been the sole breadwinner in the family, and if he has died, the family would be put to a lot of financial loss, and insurance is a protection against that financial loss. It's an unexpected loss. Somebody could have died of a heart attack, or he could have died in a road accident at the most unexpected time, and the family is not going to get his life back whatever they do. He is dead and gone. So to that extent, it's a protection from the financial loss arising out of his death. That is called insurance. Similarly, there could be a big fire accident in a factory caused by an electrical short circuit which was unexpected. Now, because the electrical short circuit has happened and the fire has raged through the factory, the goods destroyed in the fire cannot be got back. They have to be remanufactured. To that extent, they cannot be got back, but the financial loss that has been occurring that has occurred because of this fire can be compensated. And that is the characteristic of insurance. There are two types of insurance. One is called the life insurance and the other is called the non-life or general insurance. It's a well-known fact that there are two types of insurance. One is the very popular amongst individual clients, that is the life insurance. And the second is the non-life or general insurance, which is popular with both individuals and corporates. Now we shall see in each of these in greater detail. Life insurance is an insurance coverage that pays out a certain sum of money to the insured or their specified beneficiaries upon a certain event such as death of the individual who is insured. Again, don't be flabbergasted by the long winding definition of what is life insurance. I'll put it in simple words. Life insurance means compensation to either the insured person in case of his illness or disability, or to his family in case of his sudden death. That is the meaning of life insurance. Let's take, for example, a life insurance per se. Let's not talk of illness or disability. A life insurance per se. Supposing Mr. X is insured for a sum of rupees 10 lakhs. Assuming that he is insured for a sum of rupees 10 lakhs and unfortunately he dies either out of natural causes or out of accidents, then his family or the insured person's beneficiary, whoever he has nominated as the beneficiary, would get that amount of 10 lakhs from the insurance company as compensation for the financial loss incurred on account of the person's death. That is life insurance. It's as simple as that. The coverage period of life insurance is normally much more than 1 year. It's much more than 1 year because persons don't expect to die within 1 year. The lifespan of an individual runs into several years, and the average expectancy of life or the mortality rate in India has gone up so much that the average expectancy of life in India has gone well above 70 years now. So a person who takes life insurance at the age of, let's say, 26, 27 would normally want himself to be covered for a period of at least 30, 35 years or maybe even 40 years. That 40-year period is called the period of insurance or the term of insurance. That is called the term of insurance. And the person who is insured is called the insured person or the life insured. And the amount for which his insurance is taken is called the sum assured. Supposing a 27-year-old man takes a life insurance policy for, let's say, 2 crore rupees for a period of, let's say, 40 years. Then in this case, let's say the person's name is Mr. A. A is the life insured. The sum assured is rupees 2 crores, and the term of insurance is 40 years. So life insurance is normally not taken for a period of just 1 year or 2 years. It is taken for a period of much more than that, because the average life expectancy has gone up in India thanks to medical advancement. So, which means that unless the person dies in an accident or due to unexpected illnesses such as a heart attack or a brain hemorrhage or perhaps cancer, the person is not going to die before the age of, let's say, 70 or 75 normally. There are persons who outlive that age as well. But he's not going to die at the age of 30 or 35 in normal circumstances. So that means he takes a period of life coverage for much more than 1 year period. That is the characteristic of life insurance. So this requires periodic premium payments. If the person is not going to die at the age of 30, 35, he's going to live until the age of 70, he has to keep on paying premiums till the agreed term. And that premium is paid either monthly or quarterly or half yearly. That is called the period of payment. The period of payment is either monthly or the mode of payment. It's called the mode of payment is either monthly, quarterly, half yearly or annual. So he has got a choice of making payments in these four modes: monthly, quarterly, half yearly and annual. What are the risks covered by life insurance? We have talked about life insurance and how it is for a period of more than 1 year and all that. But what are the risks covered by life insurance? The primary risk covered by life insurance is premature death. Premature death meaning death at an unexpected time. I was just telling you the average life expectancy of an individual in India has gone up well above 70 years. And so if a person dies at the age of 35, 40, that's called a premature death. It could be either due to natural causes such as illnesses or due to accidents. But then one of the foremost risks covered by life insurance is the premature death. Another risk which is covered by the life insurance company is income during retirement. Normally people, when they retire, they stop earning. So to that extent, the insurance policy also provides for giving them earnings after they retire as well. The products in life insurance are the following. One is called the whole life policy. Second is called the term policy. The third is called the investment linked policy, which is called the unit linked policy or the ULIP. And we have got the life annuity plan. And of course, we have got medical and health insurance policies also covered by the life insurance companies. We'll now see each of these policies in some detail. First, we'll see what is a whole life policy. Whole life policy is a lifelong protection, which means that the protection will be available to the insured and his family until the insured person dies, irrespective of the age at which he dies. That is called the lifelong protection. Normally, insurance companies, when they say whole life, they give a protection up to the age of 100, because normally most people are not expected to live beyond the age of 100 years. So the whole life policy covers up to the age of 100, which means that most people would die before that and their entire life is covered. That is called the lifelong protection. Premiums are paid throughout the person's life. Obviously, when you want coverage for the whole life, you have to pay premium as well for the whole life. The money, including any bonuses, will be paid when the insured passes away or suffers total and permanent disability. I think this point is very clear. The money will be paid along with bonuses, if any, to the insured person's beneficiaries when he passes away, or when the insured person does not pass away, but he suffers from total and permanent disability, which means that he cannot work anymore, he cannot move around anymore. Maybe he has got the loss of a couple of limbs or eyesight or hands and so on and so forth. So which means that he's practically paralyzed. That is the meaning of the word permanent disability. Term life insurance is the most popular form of insurance and the most profitable one for the insurance companies too, because term life insurance offers insurance protection for a limited period only, whereby the money is paid up if the insured person dies or if he suffers total and permanent disability. The meaning of the statement is very simple. Supposing a person has taken a term life insurance for a period of 25 years. Now, the insurance company will pay the amount of the sum assured only when he dies before the 25th year. or he suffers a total and permanent disability. Otherwise, the premium paid by the insured person goes waste. He will not get anything out of this policy. That is the meaning of the word term policy. Term policy covers unexpected death before the end of the term, before the end of the insurance policy's term. And if a person survives that term, then he does not get any benefit. However, recently a lot of insurance companies have provided for return of premium in case a person survives the term. Recent insurance policies are providing for return of premium. Supposing the premium paid has been, let's say, 5 lakh rupees in the during the term of the during the term of the insured person's life, then the recent insurance policies given by various companies are providing for the return of this premium, this 5 lakh rupees. So there is to that extent some solace for the insured person that if he survives the term of the coverage, he at least gets his money back. He at least gets whatever he has paid, he gets it back from the insurance company. That is called the return of premium. The investment or the endowment life insurance, is a combination of protection and savings. Why is it called a combination of protection and savings? We will see. It provides for a sum assured. It provides for a payment of a sum assured in case of death during the term, and if the insured survives specified time periods, example 10, 15, 20, 25 years during the term of the policy, he can opt to receive part sums as sum assured known as endowment. I'll explain to you in simpler words. An endowment policy is a kind of a combination of protection and savings. It is a kind of a term insurance policy only, and it has to be taken for a certain fixed period. An endowment policy could be taken for a 30-year period, let's assume. A person is 25 years old, he can, let's say, take an insurance policy, an endowment life insurance policy for a period of 35 years. That means until the age of 60. Now, the first and foremost risk covered by the insurance company in this endowment policy is that if he passes at any time during this period up to the age of 60 years, the company will pay the sum assured. I've already explained to you what is the sum assured. So if he passes away any time during this period up to the age of 60, he will get this, the insured person's family will get the sum assured. On the other hand, if he survives that 60-year period, he can actually get or plan to get part of the sum assured in various stages during his lifetime. Of course, that he has to decide in advance at the time of taking the policy itself. For example, a person is 25 years old. He could opt for an endowment at the age of 35, that is 10 years from the date of policy, because at the age of 35, probably he would have been married and his child would have started going to school. So for school admissions and related expenses, he can opt to get a part of the sum assured as an endowment. And the next endowment could come, let's say, 15 years later when the child goes to college. That means when he will be roughly 45 to 50 years old, he can opt for a certain amount of endowment. And the next endowment could come 10 years later, that is on the end of the maturity of the period, that is at the age of 60, when probably his daughter is ready for marriage. That is the meaning of the word endowment. He is endowed with a certain sum of money at specified intervals of 10, 15, 20 years, whatever the case may be, as agreed upon between the insured person and the life insurance company before the policy is taken. The most important point to note here is that the agreement is signed beforehand. He cannot opt for an endowment policy after the policy is taken. If he opts for a term policy, it's a pure and simple term policy. If he survives the term, he will get the return of premium maybe, or if he does not survive the term, he dies during the term, his family will get the sum assured. That is the meaning of the word in term policy. But however, endowment is both protection and savings, because he is not only protected from, his family is protected from financial loss in case this person dies before the end of the specified term. Otherwise, if he survives specified intervals during the term, he can opt for getting endowed with portions of the sum assured. That is how an endowment policy works. The time frames can be linked to specific events. As I told you, the child may be going to school, then the child may complete school and go to college, and then the child may go for higher studies, or he or she can get married. So it can be linked to specific events in the lives of the person insured as well as his family. Then investment-linked plans are also known as unit-linked plans or ULIPs. These are the most popular form of popular form of insurance policies going around in the market nowadays. They are known as ULIPs. The premium paid is to buy life insurance protection as well as units in a fund managed by the life insurance companies. The money premium is paid to buy both life insurance protection as well as units in a fund managed by the life insurance company. That is why it is called unit-linked insurance plan or ULIP. It's a combination of protection and investment. The benefits paid to the insured or his nominee will depend on the price of the units at the time of the surrender of the policy or when the insured passes away. It is like an insurance, it's like a mutual fund company. When he purchases the policy by paying the premium, he not only buys life insurance but also buys units. And those units are in a kind of a mutual fund managed by the life insurance company themselves. And at the time of death, he will get the money back depending on the price of the units at the time of death. So I will give you an example. Supposing a person takes a ULIP policy for 50 lakh rupees, assuming that he gets a unit policy, he takes a ULIP policy for an amount of 50 lakh rupees. And when he pays premium, the part of the money goes towards protection of his life, pure and simple life insurance. The remaining part will go towards purchasing of units in a fund which is managed by not some other asset management company, but by the insurance company themselves. So when this person dies, the amount paid to him will be not just 50 lakhs, but the value of the units which has been bought with his premium. So to that extent, he gets not only the amount sum assured, but also the value of the units which he has bought. And this value of the unit is based on what we saw in the mutual fund capsule, what is known as the NAV, the net asset value. So this is how the ULIP plan functions. But the underlying principle of insurance is protection, but here protection is combined with investment also. And that investment is done in units. So the policy, when it is encashed, either due to surrender or due to death of the person, it will come with the sum assured plus the market value of the units which have been bought with the premium. That is how the concept of a unit-linked plan works. The ULIPs are very famous in the country today because of two reasons. One is, first of all, he gets protection from life. And second thing is, there is every chance that the money invested out of his premium would have grown far, far higher than the market because of good fund management by the insurance company. So the people want investment as well as protection. They go to the ULIP plans. Life annuity plans are those which are there for the life annuity, or in other words, pension. These are also known as pension plans. They give the insured a regular sum of money till his death or a specified period. This is decided at the beginning. When a person takes a life annuity plan, he or she decides that I must get a certain amount of rupees from the insurance company till I die, or maybe till my 85th year. This is agreed upon at the time of the insurance policy being taken itself. So the insurance company will agree to provide an annuity. Annuity means annual payments, or they will agree to provide, the annuity is also called a pension. That is why annuity plans are also known as pension plans. So they provide the insured a certain sum of money either till his death or for an agreed period of time, And however, this is agreed at the time of taking the policy itself. It's a series of payment until the insured passes away. The payment from the annuity plans could be either monthly or quarterly or half yearly or yearly. That is also decided upon at the time when the policy is taken. So it's a series of payments. The insurance company will keep on paying. It is almost like getting a monthly pension. The types of annuity plans include immediate annuity or deferred annuity. What is immediate annuity? Which means that the insured person will start getting immediate pensions. Or he can decide that, no, I don't want any pensions now. I will start getting them when I retire. Maybe after the age of 60, he can start getting his annuity. In which case, the life is covered. No doubt the life is covered. Whenever he dies, his family will get the sum assured. But in case he is not going to die, let's say till the 60th year, from the 60th year onwards, he can opt to choose, or he can choose to opt for regular pension payments. That is the meaning of the word deferred annuity. He is not taking it now. It is not an immediate payment. It doesn't start with the next year. It can start from the 60th year onwards. That is the deferred payment. However, he has to keep paying premiums until he starts getting his annuity. Apart from these types of life insurance policies, the whole life, the whole life, the term life, the endowment plan, the pension plan, and the unit-linked insurance plan, there are also health and medical insurance offered by the life insurance companies themselves. Health insurance is also called the medical insurance. Medical and health insurance, or MHI, is an insurance policy which is designed to cover the cost of private medical treatment, which can be very expensive, especially with hospitalization and surgery. The statement is very simple. It provides for hospitalization and surgery, especially in private hospitals, because it is very expensive. So the insurance companies provide for the treatment. The insurance companies have tied up with various hospitals to go in for a cashless treatment, or sometimes if they are not in the approved list of hospitals, the insured person can go and get himself treated at another hospital and get reimbursement. But the fact remains that insurance companies provide for hospitalization and surgery in case of necessity, and that is called the medical insurance or health insurance, for which of course a certain premium is paid. And it also covers cost of taking treatment during emergencies. At the time of emergency, the insured person need not run from pillar to post trying to garner money for his treatment. He instead can just opt to make a claim on his health or medical insurance policy. Of course, what are the types of health insurance? First of all, one is hospitalization and surgical life insurance. The second is dreaded disease or critical illnesses. The third is disability income. What is disability? When a person has an accident and loses a part of his body. It could be either the limbs, the hands or the legs, or his eyesight, one of them, then he is disabled. He cannot perform his normal functions. He cannot go to office and work. He cannot go to a factory and work. That is why it is called disability. And that is why he is called, the insurance is called the disability insurance. He is disabled. He is prevented from doing normal work. That is the meaning of the word disability. So the medical insurance provides hospitalization and surgical insurance. Dreaded disease. What is dreaded disease? It normally referred to as cancer. Normally referred to as cancer and HIV. These are the dreaded diseases that are mainly recognized. Dreaded diseases or critical illness. Critical illness following a brain hemorrhage or a heart attack or whatever it could be. So they provide for covering dreaded diseases or critical health insurance or critical illness insurance, and they also provide for disability income insurance. He loses his income because of a disability. And of course, hospital income insurance means that they have to, the insured person has to pay to the hospital for hospitalization charges. That is also provided for in this policy. Each policy, of course, offers different benefits, and different insurance companies offer different scopes of coverage. So this is something which we need to understand. Not all health insurance policies are the same. There are a variety of health insurance policies offered by different sets of insurance companies, and each of them is different by itself. There is no permanent yardstick on what a health insurance policy can cover. Some health insurance policies cover diabetes. Some health insurance policies do not cover diabetes. Some health insurance policies cover cataract operations of the eye. Some do not. Most or perhaps none of the insurance companies cover dental treatment. Dental treatment in insurance parlance is not called a disease, it's called a cosmetic surgery. And cosmetic surgery is not covered by insurance. It's rather sad to note that dental surgery is not covered by insurance because a person can live without his teeth. But then, when he lives without his teeth, he definitely suffers a lot of damage to his body because he cannot eat properly, he cannot chew properly, he cannot drink properly. I mean, the basic functions of speech is also impaired. But it's rather a state of wonder why the government has not recognized dental surgery as a means of covering them with an insurance policy. Still, dental surgery is treated as cosmetic. But in my personal opinion, dental surgery is no more cosmetic. Is no more cosmetic. We are not talking of bleaching the teeth to make them white, but we are talking of root canal treatments and replacement of dentures to cover the mouth in such a way that the person can chew and eat properly. And it's high time that the government recognized this fact and included dental surgery as also a form of health insurance. But however, we must understand that today dental surgery is not covered. But each insurance company has got their own policies, their own systems, their own procedures for covering different types of illnesses. Some of them cover head to toe, some of them don't cover the cataract in the case of eyes, some of them don't cover diabetes, some of them don't cover pre-existing diseases and so on and so forth. So, I mean, it's very difficult to list them all in one presentation saying which company offers what. It is too vast. It's too vast a subject to be covered with the presentation in one slide saying that this company offers this coverage. There are any number of companies available. In India, there are approximately 26 health insurance companies available, and each of them has got multitudes of policies covering multitudes of illnesses, and the coverage also depends on each type of on each insurance company. Some offer intraday hospitalization benefits, some do not offer intraday. Intraday means for a part of the day. A cataract surgery, for example, requires hospitalization for just a period of 3 to 4 hours. Some policies provide for that, some policies do not. Some policies insist that you should be hospitalized for a minimum period of 24 hours. But whereas other companies do not insist on a period of hospitalization for a period of 24 hours. So it all depends from insurance company to insurance company. They have got their own system of analyzing the probability and analyzing the chances that the claims will come. So each coverage by each insurance company is totally different. There could be some common elements, no doubt, but then most of them are different from each other. So to that extent, we must understand that not all health insurance policies are the same. Not all coverages provided by the different companies are the same. So, this is an introduction to life insurance as such. We have just seen what is insurance first of all, what are the types of insurance, life and non-life. Under life insurance, we have seen what are the different types of policies available. We have seen a whole life policy, we have seen a term policy, we have seen an endowment policy, we have seen a unit linked investment plan or a ULIP, or we have seen what is known as an annuity plan or a pension plan. We have also seen health and medical insurance. So this is the first part in the series of 2 parts on insurance. So I enjoyed making this presentation very much. I hope you too enjoyed watching this. Until I see you in the second part of the insurance video, it's bye from me for now. I hope you enjoyed watching it. Keep continuing to watch Talent Sprint videos. Thank you and bye.